We are launching into a deep dive on Q2 Holdings, ticker QTWO, following their Q3 2025 earnings call. And if you follow the digital banking space, you know this call wasn't just another quarterly check-in. It really felt like the definitive proof point for this massive strategic pivot that sent the stock soaring.
Exactly. I mean, when a tech stock that has lagged the sector suddenly jumps, almost 15% overnight, that signals a complete change in the market's perception. CEO Matt Flake and CFO Jonathan Price, they didn't just report numbers on this call. They outlined a future where Q2 transformed.
Transforms from what to what, exactly?
From a high-growth fintech, often criticized for its execution, into a disciplined, profitable, and essential enterprise infrastructure provider.
Right. So our mission today is pretty simple. We are extracting the essential nuggets from this source material. We're going to look at the metrics that define the beat, but more importantly, we're going to try and understand the three strategic pillars here: profitability, enterprise quality, and this new idea of AI trust.
Those are the drivers. They're what's behind this new narrative and really what defines the investment thesis for 2026.
Okay, so let's start with the results snapshot, because the numbers themselves were, they were clean and really convincing.
They were remarkably strong. Total revenue clocked in at $201.7 million. That easily surpassed the street's consensus of about $197.5 million. So that's a solid 15% year-over-year growth. The top-line engine is very healthy.
But the bottom line is where the story truly changed, right?
Yeah.
For years, Q2 was characterized by high spend.
Exactly. And now we're seeing the leverage kick in. Their GAAP diluted EPS landed at 23 cents.
Okay, but put that into context for us.
Well, last year, at the same time, they posted a loss of 20 cents a share. That move from negative 20 cents to positive 23 cents is a massive structural leap, and it just blew past the estimated 14 cents.
Wow. And that structural leap, does it show up in the non-GAAP figures too?
It does. Adjusted EPS was 57 cents, just a little ahead of the 55-cent consensus. But if you want the one number that really embodies this new strategy of disciplined growth, you have to look at adjusted EBITDA. They hit a record $48.8 million.
50% year-over-year growth in adjusted EBITDA.
50%.
That is a serious acceleration.
It is. And it pushed the margin up to 24.2%. That's an expansion of 560 basis points from last year. This margin expansion, it's the tangible evidence. Management isn't just talking about profitable growth anymore, they're actually executing.
That margin expansion is fantastic, but we have to ask, is this sustainable? How much of this momentum is repeatable?
That's the key question, and it brings us directly to the quality of their revenue. Subscription revenue is still the dominant piece, hitting $165.2 million. That's 82% of the total mix. And critically, that stream grew 18% year over year.
So more of the growth is coming from the higher margin recurring software fees.
Precisely. That mix shift is the fundamental engine driving that EBITDA margin expansion you just mentioned.
So the foundation is solid. Okay, what about the forward-looking metrics, the stuff that indicates future growth?
The indicators are screaming confidence.
Yeah.
You look at annual recurring revenue, ARR, it grew 14% year over year to $745.4 million. But the strongest signal, the one for future revenue visibility, is the total backlog. They call it RPO.
Wait, RPO, just to make sure we're all tracking, that's remaining performance obligation, right?
Yeah.
It's basically future contracted revenue that's guaranteed to be booked later.
Exactly. It's the contracted growth pipeline. And that backlog accelerated, reaching about $2.5 billion.
$2.5 billion, yeah.
That figure represents a massive 24% growth year over year and a healthy 7% sequential increase. The CFO also shared an important detail. He said the ARR strength benefited from a normalization in churn. They had some customer losses concentrated in Q2, but those rates are stabilizing now, which, removes a layer of risk.
And that operational stability is clearly feeding the balance sheet. They generated $37 million in free cash flow in Q3 alone, which brings their year-to-date total to, what, over $100 million?
$116.8 million year-to-date. It shows much better cash conversion. They're no longer burning cash, they're building it.
Okay, and that cash flow directly empowers the next pillar of the narrative, this trajectory toward what you'd call premium software margins.
Right. Non-GAAP gross margin improved to 57.9% this quarter. That's up nearly 2 full points from a year ago.
And this is where the call got really interesting. Management wasn't shy about the future. They're targeting full year 2025 gross margin expansion of at least 200 basis points. But the really eye-watering target for investors is the projection of a gross margin of at least 60% for the full year 2026. Hitting that 60% threshold is a huge deal.
It separates a good SaaS company from a great one. And this is where the conversation became incredibly specific and I think credible. That 60% target, it isn't just wishful thinking. It has a clear physical lever tied to it. The single biggest driver is the scheduled completion of the cloud migration project on the digital banking side.
Okay, so tell us simply, how does moving from their old data centers to the cloud automatically guarantee that kind of margin jump?
It's a guaranteed boost for two reasons. First, the obvious one. Moving to the cloud reduces operating expenses, less power, less maintenance. But the real structural kicker is on the accounting side. When they finally exit those old, expensive data centers, the associated depreciation for all that hardware rolls off the books.
So it's a non-cash expense that just vanishes.
It just disappears. And because gross margin is calculated after cost of revenue, removing that massive legacy depreciation expense gives them an automatic, non-sales dependent increase. It helps them hit that 60% target almost mechanically.
That's a fantastic insight. It removes some of that execution risk because the savings are baked into a migration schedule, not just a sales quota. But, the market has heard promises of efficiency before. How do we know these savings won't just get reinvested somewhere else?
A very relevant point. But they showed discipline in Q3. Total operating expenses dropped from over 41% of revenue a year ago to under 38% this quarter. They're clearly optimizing the cost structure while still delivering that top-line growth.
Okay, so they've proven they can execute internally. Does that discipline translate into bigger, more meaningful deals externally? Which brings us to pillar number 2, enterprise quality.
Absolutely. The quality of the bookings this quarter was remarkable. Management highlighted record Q3 bookings, driven by a heavier weighting toward larger enterprise deals.
They signed 7 total Tier 1 and enterprise contracts. Give us an example of who they're attracting now.
Well, the highlight was securing a net new digital banking win with a top 50 U.S. bank. We're talking an institution with over $80 billion in assets. Securing a net new customer of that scale is a powerful competitive validation.
And it wasn't just new logos, right? They also expanded within their existing base.
Correct. They secured the largest fraud deal in company history. This was an expansion at an existing $200 billion digital banking customer. It just underscores a crucial tailwind. Even if banks are cautious, they must invest in risk and fraud prevention. Q2 is capturing that share.
They also gave some interesting color on the M&A environment in banking.
They did. In 2 recent instances where a smaller Q2 bank was acquired by a larger institution, the acquiring bank actually chose to keep the Q2 platform for the combined entity.
That's probably the strongest validation you can get.
It's huge. It shows the platform is scalable and attractive enough that a bigger bank chooses it over their own existing solution.
Let's pivot to the third pillar, AI trust. Q2 is positioning themselves as the indispensable AI partner for banks. What's their roadmap?
It's a comprehensive, 3-pronged roadmap they showed off at their recent Dev Days event. First, they're launching an AI co-pilot for both account holders and bank staff using natural language prompts. This should fundamentally lower the cost of customer support for their banks.
And the second part targets developers, right?
Yes. They showed off AI-assisted coding tools right inside their SDK, which makes developer documentation conversational. This is key because it accelerates time to market for the bank's own dev teams.
Smart. So internal efficiency and customer speed to market. What was the third point on data?
The third point was a new partner data integration strategy. Q2 already has over 1,000 backend integrations. Management really emphasized that their long history of compliance and secure data handling makes them the only trusted partner for banks.
Why is that trust angle so crucial? Why can't a bank just, plug into ChatGPT or another large model directly?
Because banks are highly regulated. They're risk averse. They can't just feed confidential customer data into a general AI model. Q2 acts as the necessary regulatory wrapper and secure data funnel. Management's insight is that AI will flow through their platform, not around it. They are the safe on-ramp for banks to adopt AI responsibly. That's a massive competitive moat.
A compelling argument.
Yeah.
Now, let's switch to the management structure and the strongest signal of financial maturity we saw on the call. Capital allocation.
Right. They announced key organizational changes. Momu Kamala was promoted to Chief Operating Officer, focused on execution and service. Kirk Coleman moved to Chief Business Officer, focusing entirely on the go-to-market organization and sales. It's a clear alignment.
And the signal that truly changed the narrative from, a growth at any cost company to a disciplined enterprise player was the board authorizing a new $150 million share repurchase program. Wait, isn't that the first explicit formal capital return plan they've ever had?
It is, and that's why it's so significant. Funding this buyback with their strong free cash flow formalizes a capital return strategy that was completely absent before. It just signals financial maturity. They can afford to return capital to shareholders now.
And if we pull back, you have to remember where the stock was before this report. It was down about 40% year to date, just lagging the whole software sector.
And this report answered those skeptics head on. They didn't just beat Q3. They raised the full year 2025 guidance for revenue and adjusted EBITDA. And they tightened the 2026 outlook, raising subscription revenue growth to about 13.5% and projecting EBITDA margin expansion of about 250 basis points.
And the market they operate in, the digital banking SaaS market, it provides a strong safety net for those targets. We're talking over $20 billion in 2025, growing from there.
Exactly. The combination of strong financials, the buyback, and the AI traction marks a profound shift. The market is now pricing them as a capital-disciplined, highly profitable infrastructure provider. That's why the stock reacted so decisively.
Now, for the segment everyone is waiting for, the trade idea. And as always, we have to emphasize this segment offers purely speculative ideas based on this call. It is not financial advice. We are just exploring the outer limits of a high conviction thesis.
And the thesis here is built entirely on execution. The Q3 beat, the guidance raise, the buyback. They have structurally de-risked the near term. The only major lingering risk being priced in is management's ability to hit those aggressive 2026 targets, the 60% gross margin, the EBITDA expansion. If they execute, the stock will see significant multiple expansion.
So if you have strong conviction that the CFO can deliver on those 2026 margins, what is the most outrageous but plausible trade idea?
Well, the optimal structure for a bet on operational execution isn't a simple call option. Those can be expensive. Instead, we would propose to sell deep out of the money put options expiring after Q4 2026 earnings.
Okay, explain the rationale. Why sell puts that far out?
You are deliberately targeting an expiration date after the market will have visibility into whether Q2 hit that critical 60% gross margin. By selling deep out of the money puts, you're collecting premium today. You're essentially selling insurance against a catastrophic drop that the market might still fear. If Q2 executes, the stock price should appreciate significantly, making those low-strike put options expire worthless. It allows you to monetize the removal of that execution risk premium. It's a direct bet on operational follow-through.
A high-conviction bet on the CFO and the COO's ability to deliver.
Okay, to recap our deep dive, Q3 was an undeniable overperformance, backed by record enterprise bookings, a pivot to profitability, and raised guidance for 2025 and 2026.
And the key structural signals are the new $150 million buyback and that credible mechanical roadmap to 60% gross margins. The narrative has definitively shifted. Management has strongly positioned Q2 as the indispensable AI partner for banks, emphasizing that AI will flow through their platform, not around it. But this leaves us with the critical question now for investors, the variable to watch in 2026. How fast will the commercialization of those new AI features like the AI Copilot translate into measurable, accelerated ARR growth and further pricing power beyond the already raised targets?
The speed of that AI monetization, that will define the next leg of expansion and determine if the stock can achieve a true premium valuation. That is the ultimate frontier.
That wraps up our Don't Dive into Q2 Holdings Q3 2025 earnings call. Thank you for joining us on this exploration, and we look forward to continuing your learning journey next time.